For example, this is portfolio immunization, which means making asset duration equal to liability duration. Using short-term interest rate futures. And yes.
So how long before they failed did y'all like consult them about that?
But it turned out about 4 months ago. I mean, one of the things I wrote is you have actually deposits concentration risk. If something happened and these people did a bank run on you, most of your liquid assets are in T bonds. They're going to lose in value. So you're going to go down.
So they just ignore it?
They just ignored it because, they were making a lot of money from those and they just ignored it. Said, our clients won't take their money. But they did. And these people kind of knew it was coming. About a week before Fed took them down, the CEO and CFO had stock options, and these had exercise price of $105, and the stock was trading around 280. About a year before that, stock was trading at 600. So these guys chose not to exercise their options when the stock was trading at 600. They had the right to buy it at 100. They would have made a lot of money just thinking stock is going to go up even more. But just 1 week before, it was kind of obvious. Uh, they exercised them at 280, and I think they both made over $30 million each. That's actually should be considered insider trading, but nobody did anything about it because they knew it was coming. I mean, you didn't exercise it when it was 600, but you did when it was 280, which means you had information that it was going to go down. About a week after, the stock was trading at $5, I think. It's worth zero now. But, so they knew it was coming. We told them that this was a risk. They chose not to do anything about it. More importantly, the regulators did not say anything about it either. Do you know why Silicon Valley went down? It went down because of the change first Trump administration made in 2017. After the crash of 2008, the Dodd-Frank Act classified banks into two groups. One, banks that are important for the system. So if they went down, it could create a domino effect because a lot of banks, lend money to each other. And they put the threshold at $50 billion in assets. And when the Trump administration came, they changed that classification to 250. The difference is if you're below that threshold, you still have an overseer. And if you're a holding company, it's Fed. If you're a nationally chartered bank, it's OCC, Office of the Controller of Currency. Otherwise, it's FDIC. You get your quarterly examinations. So your regulator comes and visits you every 3 months. But if you're systemic, if you're a bank that is important for the system, there is actually a resident regulator that sits in your headquarters. Every day they look at your uh, P&L statements, portfolio value statements, so so that they could do an intervention long before it becomes a problem. Silicon Valley Bank was below that threshold, so the regulator actually didn't have timely information. If the Trump administration had not changed the law, they would have had somebody, and this problem would have been addressed long before. Same thing happened with First Republic Bank. They also had $100 billion in assets. In the old regime, they would have been systemically important bank. Now they are not. What are you going to do? I mean, they basically wiped out all the Silicon Valley Bank shareholders. All right. Uh, let me briefly talk about uh, certain bonds are callable bonds. Okay, the callable bonds are issuer has the right to uh, redeem the bonds early by paying the call price. For example, you could have a face value of 1,000 and call price is 1,050. Why would anybody do this? Let's say I'm a bank or I'm Treasury. Treasury bonds are rarely callable, but some of them are there. I issued a bond in 2018 when the bond yields were around 4% or so. And that means every year I pay 4% of face value as uh, coupon. During the COVID crisis, 10-year bond yields went down as low as 0.6%. So I have two options. Either I'm going to keep paying those, or I can call it and issue a new bond at the current rates. So if the yields come down a lot, it is more likely for the issuer to call the bond. That's, of course, precisely the wrong time for the bond owners, because if you call my bond, I was happy to earn 4% coupon. Then you give my money back to me. So what am I going to do that money? If I invest it back in, I'm going to get only 0.6%. So that value has an option. So typically value of callable bonds are less than value of otherwise bonds. Sometimes you're going to see something called yield to call. First, I'm going to show you how to calculate yield to maturity of a given bond. And after yield to call, I'll let you guys go. There are some more problems, but I'm going to do those in specific problems. In fact, I already put them in. Let me see how many I'm going to do. Yeah, there's going to be 18 of them for each different kind of problems. I'll do those tonight. First, calculating YTM. Find the YTM that gives you the current price of a bond, everything else being the same. Let's do an example. Suppose I have a 20-year bond, semi-annual, face value 1,000, coupon rate equals 3%, and bond is trading at 950. So this time we know the bond value. We're going to figure out what yield to maturity is going to give us that bond value. Just like we did on other stuff,